Dividends is a hot topic for our listeners. To have a source of passive income and capital appreciation at the same time is the ultimate dream. It's like earning passive income forever. As Singaporean retail investors, we usually start off investing in dividend stocks and REITs locally. Today, we're going to venture out into the world and find out what are the opportunities for dividend stocks and funds or ETFs globally. What do you need to take note of in terms of taxes, forex, and other risks? How do you screen for dividend stocks, and what should your dividend play be like in the new environment of inflation and rising interest rates? Join us in the global dividend hunt. Hello, my name is Andrew and welcome to another Chill with TFC episode. In this series, we talk to interesting people with relevant experience and insights to help us learn from their perspectives so that we can create the life we love and manage our finances well. My guest today has more than 10 years of content experience in the financial industry, including stints at Schroders and the Motley Fool. He's head of content and investment lead at ProsperUs by CGS-CIMB Securities. His investing experience has led him to develop a style of investing that is focused on the long term. Let's welcome Timothy Phillips. Welcome back.
Thank you.
Right. Previously, we shared with us on a different topic.
Yeah.
Right. And it's more about the Hong Kong markets.
Hong Kong markets, right. Exactly.
Today, we're going to expand it to more global point of view.
Yep.
And we're going to talk about dividends.
Right.
So is dividends the secret to earning passive income forever? Where we don't eat into our capital and, we just keep earning dividends.
Yeah.
And live the great life.
I think so. I think it's more about a focus on, as I just spoke to you earlier, about generating total returns. So I'll explain the difference there. So total returns is the price return plus the what you would receive from the dividend. So effectively, say you earn a price return of 10% in a year and the dividend yield is 3%, then your total return would be 13%.
So the price is referring to the stock price?
Yeah, the stock price, and then
goes
the
up in
dividend yield, effectively that's a percentage, and then you can add that on top of your price return to get the total return. So it's a better gauge of a dividend stock's return over time is the total return, because I think a lot of dividend investors tend to get taken in by the dividend yield, and if it's high, they like to go for it. And then that's coupled with a falling share price, so that tends to be dangerous. So I think the best focus for dividend investors and actually all stock investors is to focus on the total return.
So look at total return, and that's your secret to prospering forever.
Yeah, and total return, I think over a good time frame, so say 3, 5, 10 years, the longer the better, especially for dividend investors. You want the dividend to be rising sustainably over a period of 5 or 10 or even 20, 30 years. You've got some companies that pay dividends or rising dividends for over 50 or 60 years. So, those are in the US known as dividend aristocrats. So those are the companies that you want to identify and you want to hold. And, they tend to be really well-run companies. They generate a lot of free cash flow. They generate a lot of cash generally from operations. And they tend to return that back to shareholders as well.
Do they tend to be more value companies rather than growth companies? And of course, you can define value and growth in this case.
Yeah. So I think they do tend to be more, on a traditional metric of price to earnings, they tend to be cheaper than what you would consider as a growth company, like a tech company that reinvests all its cash flow and, maybe is loss making. So they actually turn profits. They obviously generate free cash flow. And they tend to trade at a lower, price to earnings multiple than you would consider growth stocks. But I wouldn't consider them exactly value, because I think value is very subjective. It depends on, the historical range in terms of the actual individual stock's valuation. How is it trading in relation to that historical multiple? But yeah, on the whole, I guess obviously they do trade cheaper than growth stocks.
Okay, dividends is a very popular topic among our listeners. And if you check out the Google search results, many people are really looking into dividend articles and dividend kind of content.
Right.
But many of us, for myself especially, I'm more familiar with how the dividend play is working out in Singapore. For example, REITs, bank stocks.
Yeah.
So that's more of what I understand.
Yeah.
But today we're going to take a global perspective.
Right.
So coming from a Singaporean point of view, this is what I understand about the local dividend play.
Yeah.
But when I venture out into US, Europe, or other parts of Asia, what should I take note of?
First off, let me just get a disclaimer in here that my compliance team will want me to. Is everything I'm going to say is not meant to be construed as personalized financial advice, and obviously do your own due diligence. And if you are seeking out advice on tax, go see a tax specialist for this kind of thing. But I think for retail investors, you can find a lot of information online, obviously, by doing your own research, and obviously experiencing it by investing. But I think the main thing that holds back Singapore investors from going into the US and buying dividend stocks is obviously there's a 30% withholding tax in US stock markets for dividends. So automatically you only get 70% of what is paid to you. So I think that is one key thing to note in the US at least. I think for other countries, if you venture into the UK, there are lots of dividend plays in the UK as well. It's good to know what the tax structure is in the UK. As far as I'm concerned, or as far as I know right now, there's actually no dividend tax on foreigners in the UK. So you do receive it up to, I think, a certain cap. And then in other jurisdictions in Europe, there should be what you would call a double taxation treaty. So there tends to be, there'll be an agreement, say, between the Netherlands and Singapore, and you'll understand if it's a Netherlands-based company, how much does it pay out in dividends, and the dividend tax rate tends to be lower, right? So the US tends to be among the highest for dividend taxes, and the rest of the world, it does vary, so you have to do your own research. But obviously, the best and the biggest companies are found in the US, so it's key to go searching for those kinds of companies there. So I think what holds people back, as I said, is that tax. But if you think about the actual act of investing over 5 or 10 years, what you want to look at is the growth of that dividend rather than the yield of the dividend.
That's where total returns come in, as
Yeah.
you were sharing just now.
Exactly. So and the growth of that dividend is really important because that obviously increases the yield over time, but it also in relation to the share price, you have to compare it to the share price as well. And so figuring out the growth over long periods of time gives you, I think, a better idea of your yield on cost. So this is a concept that is, say you invested in Starbucks in 2008, and Starbucks has been basically able to grow its dividend over the past decade for at a compound annual growth rate of about 25%, say from 2010 to 2020. So say you bought shares in 2010, and you would have bought it at a yield of, I don't know, probably like 2 or 3%. But if you had just held those shares, what would the yield be now in 2020 terms, given the dividend? So growing that dividend at 25% a year, the yield would have been, I think, around 16 or 17%, right? And then obviously you can take 30% off that, but your yield on cost is the yield, at the time that you bought it. If you're thinking about today's money terms, it would be around sort of, 9-10%, which is still amazing, right? If you think about what price you bought the shares at and what dividend it's paying now, since it's grown it at a compound annual growth rate of 25% for 10 years. And if you compare that to some of the REITs in Singapore, I mean, there are some really great REITs here, but the kind of growth in the dividend annually that you see in REITs doesn't tend to be more than sort of 4 or 5%, compounded over a long period of time. So one of the examples I used was Capitaland Integrated Commercial Trust, and from 2009 to 2019, I actually took the period just before there was a cratering in their dividend because of the pandemic. They were only able to grow at about 3.1%. So actually, the yield might be attractive, but actually the total return, and if you can then add that onto the total return, the actual growth of the dividend plus the appreciation of the share price is actually quite disappointing over that period of time. So I think it's more important to focus on the growth of the dividend and what is your yield on cost. What is it going to look like in 5 or 10 years, even after tax in the US?
So if you are building a dividend portfolio, it's worth venturing out if you consider total returns.
Yeah,
right?
because
even after taxes.
Exactly. I don't like to constrain, or I don't think any of us should constrain ourselves to a geography just because of tax. I think that's something that you have to admit, or you just not admit, but you just have to accept as part of the market there. But that shouldn't be a reason to not hold really great companies or, hold really good structural stories over sort of 5, 10, 15 years. Because they can always surprise. And, if they grow their dividend 30, 40% in 1 year, which is very common in the US for some of these companies that are really generating strong free cash flow, that's that kind of growth in a dividend, you're rarely going to find that in Singapore.
Okay, so how do you approach it? Do you go from a geographical point of view or by sectors, by industries?
I tend to look at the geographical point of view, obviously the US is one of the top ones. And the thing about the US market is it also is a really global market. So you actually have a lot of sort of ADRs, as you know. I mean, Chinese companies that are listed there, but also companies from Taiwan or from Europe. And so, for example, that again, you'd have to understand where the domicile is for that company, because they don't necessarily withhold 30%, because if they're domiciled in say Canada or the Netherlands or somewhere else in Europe, the withholding rate might be 15% because there's a double taxation treaty with Singapore's government. So you have to really dig into that, figure it out, understand what the actual taxation withholding rate is. To really sort of focus on a lower, I guess if you're thinking about lower withholding rates, if that's your thing. In terms of the sectors, a lot of it you'd find obviously utilities and power providers and a lot of consumer discretionary names that have just continued to pay rising dividends for years and years, just because the US economy is such a strong consumer economy. That tends to be where you would find the usual dividends. But I think just basically in any companies that generate a lot of free cash flow, which is effectively operating income after taxes minus capex, right? Minus investment. And so that's the cash you have left over after all the investment and operating expenses. So that is basically cash that it's very hard, I guess, to deceive shareholders about that cash that you generate on the free cash flow basis. And if they're generating really strong free cash flow, then companies will be able to pay out dividends and will be able to continue to hike that dividend over time.
30% withholding taxes still feels very painful.
Yes.
Although it depends on the time frame they're looking at.
Yeah.
And so should I be investing in for the long term? And how do you define the long term in this case?
Yeah, so I think you should invest for the long term. I mean, I'm a really strong believer in long-term investing anyway. So if you are investing based on, I guess it also depends on your time horizon, right? I mean, if you're approaching retirement, if you're 2-3 years away from retirement and you just want a safe REIT or a bank that yields 4 or 5%, that's totally fine and that's tax free. But if you're younger, I think there is definitely more scope for you to venture outside the traditional sectors you'd find here and try and invest for 10-15 years and compound those, and if you can, reinvest those dividends back into the stock, right? Because even though you're going to get a 30% haircut on the tax from the tax perspective, at least that amount, that 70%, hopefully will continue to grow quite a lot over the next 5 or 10 years if that compounds, if that dividend continues to compound. So I think it's something, again, that just like volatility in the market, you just have to accept that's part of the market in the US, but don't make that a reason not to invest in dividends, I think.
Okay.
Yeah.
So how should I screen for good dividend stocks globally?
You tend to look at a yield. You tend to look at I guess the dividend per share, and you want to understand how fast it's growing. I mean, I think one of the best ways to understand is the free cash flow yield. If that's really high, if that's rising. Again, the payout ratio is, are they able to cover their dividends? Is it a reasonable payout ratio? You don't want a company that's paying out sort of 80-90% of its earnings in dividends, just because I think that's a little bit iffy if that's going to continue. If something happens, maybe they have to cut their dividend. So what you want a company that is really easily able to cover its dividend, is able to pay that out and able to hike that over time, and obviously is growing earnings, right? So I mean, without earnings continuing to expand over time, that dividend's not going to be able to grow. But I think looking at a payout ratio of sort of like 40 to 60% is pretty comfortable for even a yield name. And actually, if you're talking about a dividend growth name, which is maybe what I consider dividend growth, is something that's probably yielding under 2%, but is growing its dividend at maybe sort of 10, 15, 20% a year, right? And there you're looking at companies paying out maybe 25% or 20% of their earnings in dividends, which gives them plenty of headroom to grow, right? Which is what you want, I think, over time. And you find that a lot in technology stocks like Apple and Microsoft. I mean, they actually pay a dividend. Not many people maybe are focus on that too much because they're so huge, but they actually are the only two out of the big tech names that pay a dividend. So I think the amount, as you know, the free cash flow that they generate is huge, right? And so they've gone the route of paying some in dividends and obviously buying back a lot of stock as well.
How are you personally building your dividend portfolio? Any lessons, any mistakes that you made?
Yeah. I think again, I think earlier when I was younger, maybe I focused a bit too much on yield and I didn't focus more on the growth. And so I think that's the mistake that I made. So there are some really great companies that yield 4, 5, 6%, but anything that's starting to yield 7, 8, 9%, you do. I for me have alarm bells ringing. Is there something up with that? Because in a world where, I mean, obviously now interest rates are rising, but previously when interest rates were so low, anything yielding that much was just maybe a warning sign or a red flag. So I think for me, I think how I'm building it now is focusing on not the yield, but more the how is that absolute DPS or dividend per share growing from on a 3-year, 5-year, 10-year horizon, and how is the business performing? How is the free cash flow growth coming along, and can they continue to deliver on that on all those fronts?
Okay, so
Yeah.
was there something recent that you did? Because
Yeah.
interest rates environment is
Right.
very different.
Right.
And is 2022 a
Right.
year
Yeah,
for
yeah.
a dividend play?
Yeah. Well, I think it's a good reminder for everyone that you can't just have Shopify and C and Twilio in your account, all these super
Growth and tech
turbocharged
stocks,
growth
yeah.
stocks,
Right,
right?
right.
Because they're gonna get haircuts of maybe you're seeing some of them up to 70, 80%. So I think everyone, no matter what your risk profile, I think you need to have some of those dividend stocks in your portfolio and just anchors. There was the decade actually in the US, which is a good example from 2000 to 2009, where the S&P on a price basis was essentially flat or slightly negative, right? But if you take in total returns, it was positive. So I think holding dividend stocks in that period of time, that decade, would have allowed you, a bit of a buffer in your portfolio and given you some income as well. So I think it's a good reminder with rising inflation and interest rates going up that now everyone's focusing on cash, right? Everyone's focusing on fundamentals. Whereas I think in the sort of last couple of years, everyone's been a bit caught up in the euphoria of the markets and all these growth stocks and these massive TAMs, like total addressable markets, that people talk about, which still holds true. There are these are great companies that are still got massive growth runways, but in terms of the price action, it's not as, people obviously not as excited, right? You see a lot of people on Twitter just saying everything's going to zero. So I think there's the height of euphoria with growth, and then now everyone's super bearish. But that doesn't mean you shouldn't stick to your investment plan. But I think that investment plan, no matter your age or your risk profile, I think it should include some what you consider sort of boring dividend stocks. But I don't consider them that boring, because I think unless you're buying something that yields, a REIT that maybe yields 5, 6%, that's pretty standard. That's maybe more of like a proxy for a bond, you would think. But some of these other businesses in consumer discretionary, that are global, that are growing dividends, they're generating real cash, right, and real cash flows. So I think that's important to have, especially in a time of uncertainty.
Okay, mention geographical, look at the US, take note of the taxes, and it really depends on whether you're approaching it from an individual stock picking point of view, or investing in funds or ETFs for a dividend play, right? You mentioned sectors. I want to go into the characteristics of each sector as well. And should I be picking stocks? Or just investing in just one fund? That's my dividend play. I'm going to get my dividends from that, and that's it for me.
Well, ETFs, are a great vehicle. I'm sure a lot of your listeners know that there are Irish domiciled ETFs. I mean, that's like a really common one where it's listed in London, but the withholding tax is 15%.
15%.
So you can buy that in London, and that's either on an accumulation basis, which means they reinvest your dividends for you, or a distribution basis, which means the ETF distributes the dividends to you on a quarterly basis. So you can pick either kind of share class. So I think from an ETF perspective, that's a good option if you really hate that 30% tax. The only downside to that is that it seems to me that it's pretty vanilla ETFs that are listed there, and obviously in the US you have a lot more opportunity to have a bigger range, right, of choice. So
You
I think
mentioned boring, so that'll be more boring.
that's the more that's the more basic, your market tracking, and obviously the yield on the S&P right now is not that exciting. I mean, it must be maybe 2% or a bit more than that. But I think if you're looking at ETF and you want a dividend ETF, or you want one that isn't distributing, or sorry, that isn't sort of hostage to that tax, then I think the Irish domiciled choices are pretty good. If you're looking from a stock picking perspective, I think that may be less emotionally torturing to pick than growth stocks, right? Because growth stocks can go up and down sort of 60, 70% in very fast periods of time. So if you're buying, I don't know, sort of, like a Walmart or a Home Depot or something like that, that really isn't gonna the volatility in those types of stocks, they tend to be a lot lower than what you would find in, I guess a Peloton or like a Zoom, right? So those types of stocks go up and down very, very quickly, and you can have drawdowns, which is sell-offs that can range from 60, 70%, whereas in the big retailers, the guys who pay dividends, they're not going to deviate too much from what the market's fallen from. So I think the S&P's down, over 10%, and something like a Walmart's probably about 10, 15% off its high. So it's similar as well, right? So it's not going to be something that is going to make you lose sleep at night, I'd say. Yeah.
So if we go into individual stock picking, let's take a look at the sectors.
Right.
For example, consumer discretionary, tech.
Yep.
What are some names that we should know about for
Okay.
dividend play?
Well, yeah, I mean, as I said with tech, right? You have Microsoft, you have Apple. I mean, just because they're such massive cash flow generators, that they're free cash flow and they're so dominant in their sectors. And again, they're the only ones who pay a dividend from the tech giants at the moment. Although there's a lot of talk about Alphabet, Google being able to, but deciding not to. So I think that's up to investors to figure out where they want to be. But in tech, those guys are the big ones, right? And they pay out in total dollar terms. I think I'm on the top 10 in the world. If you're thinking about others, I mean, TSMC is a good example of something that also they yield a pretty decent amount. They pay out a pretty good dividend. There's a lot of capex involved in chip making, so that's something you should be aware of. But because they're domiciled in Taiwan, they have a lower rate again. So they have an ADR in the US, but in terms of the tax, from my understanding, I think it's 20% for Taiwan and Singapore. So it's still a tax, but it's less than the 30%, which is good. If you're talking about just consumer discretionary, some of those names I just mentioned, like the Walmarts, the Home Depots, the Lowe's, the Targets, Lowe's and Target they're both dividend aristocrats. So they've been paying dividends for, over 25, 30 years, since they, going back to the 60s, 50s, and 60s.
Explain the dividend aristocrats for me.
Yeah, so dividend aristocrats is basically a group of dividend stocks in the US that have been paying either flat or rising dividends over, I think, the past 25 or 30 years. But some of these go back way, way longer than that. Yeah. So I think there's a threshold of 25 years to be classified as a dividend aristocrat. And a lot of these companies, they're 40, 50 years that have been paying either the same dividend or rising dividends. And so I think Walmart also falls into that category. So a lot of the consumer discretionary giants that have scale, what you would assume would have pricing power now that we're going into an inflationary environment, they also pay very solid dividends, and their payout ratios are very reasonable, but they don't yield a lot, right? So that's something you have to accept. But a lot of them are growing their dividend as well at pretty reasonable clips. So it's more about identifying what business you want to be in, what sector you want to be in. Does that stock fit your risk profile? Is it growing at the rate you want that dividend to grow? And importantly, obviously, is that backed up by the fundamentals? I mean, it's key when you're picking stocks anyway to understand the fundamentals of the business and make sure the dividend is well funded.
Could you explain their pricing power in an inflationary environment?
Yeah, right. So I think with inflation, prices, obviously they will go up for a basket of goods. And so pricing power is effectively a business's ability to raise the price of its good or the pricing of its goods without losing market share, right? So I think it's something that is sort of the holy grail of businesses in inflationary environments, right? They want to be able to raise prices without affecting their market share and affecting their revenue growth. And so I think you've just seen Netflix raise the price of their subscription. So I think we'll figure this out over the next few months if these kinds of price hikes, whether it's affected the business much. My inclination is with Netflix, it probably hasn't. And then also with Amazon Prime, they just raised their Amazon Prime subscription in the US pricing wise on an annual basis. don't think that's going to impact them just because Amazon's so embedded in everybody's lives. So I think it's a good barometer of how important these services are or these goods are to people in their lives. And if they can retain that pricing power and they can continue to grow despite inflation rising, climbing, then it's a good sign for the business.
What sectors are you looking at, or what's attractive to you right now
What's attractive to me right
for
now?
this year?
This year, I don't know. I think this year, from a dividend perspective, I think from a dividend perspective, as I said, the consumer discretionary names, the big tech guys who have done really well. I think healthcare is one of those that is always going to be important. There are some healthcare companies in the U.S. that pay pretty good dividends, and it's one of those sectors that tends to be pretty defensive because everybody, in terms of medical devices, medical services, there's always a need and demand for that, right? No matter what happens. And then if you're looking at clean energy, renewable energy, there's definitely opportunities in those sectors. I think it had a really good 2020, didn't have a very good 2021, renewable energy. But I think it's one of those themes over the next 10, 15 years because of that massive drive to decarbonize. That's something that it will play out over a longer period of time. So I think I would suggest not to be so downbeat just based on last year's price action. Just think longer term and see what kind of projects a lot of these power providers are generating, and some of them do pay pretty decent dividend yields of over 3%. So I would keep an eye out for those.
Because
those
traditionally
companies.
for a dividend play, I might be looking at banks.
Yeah,
I might be looking
banks
at
as well.
consumer discretionary.
Yeah.
But you're talking about something to look at in the future.
Yeah,
In terms of the technology, healthcare,
healthcare,
clean energy.
clean energy, yeah. Yes, I think banks are, in the US at least, from my perspective, they've always been more attractive than Europe, just because Europe has always had major issues since the global financial crisis with getting debt off their balance sheets, the stress testing, all that kind of stuff that the Federal Reserve did post 2008, I think really helped the banking sector in the US. So the banks are doing quite well. Obviously, the big ones like JP Morgan, Bank of America, even Wells Fargo's, after that nightmare that it had a few years ago, is starting to recover. But European banks, they are still, I think, weighed down by just the slow growth in Europe. Obviously, there's a lot of opinion for Europe to pick back up and the growth to really sort of come to the fore there, and everyone's talking about the rotation into Europe. But I think European banks, I think this is maybe a differentiation between Europe and the US, at least in terms of dividends. In the UK, for example, just before the pandemic, there were lots of companies that were yielding, 5-6%, paying out loads of dividends, which is great. And UK investors tend to really like dividends. It's a bit similar to Singapore in that sense, but they weren't very well covered, the dividends in the UK. So you saw a lot of energy companies, banks, as soon as the pandemic hit, they just had to cut their dividends straight away. That didn't really happen in the US, because in the US, a lot of companies return money to shareholders via share buybacks, right? So share buybacks are just a tax-efficient way of returning money to shareholders. So they buy back open shares on the market, and then they obviously cancel those shares. And so sometimes it can have maybe unintended consequences where EPS or earnings per share rises, but maybe that's a result of the cancellation of shares. But the great thing about share buybacks, at least, is that you don't need to, you can cut those, right? Whereas dividends are much more heavily defended by management teams. So you saw massive pullbacks, obviously, in share buyback programs after the pandemic in the US, but most dividends held up pretty well. So I think that's something as well to consider, at least from my perspective, when I think about Europe versus the US for dividends, is a lot of European companies, or at least in the UK, maybe there was a lot of hype around dividends, but it wasn't sustainable hype. Whereas in the US, it tends to be quite sustainable. It tends to be pretty stable, even though your yield is not going to be, what you would find elsewhere. But for me as a long-term investor, I'm much more focused, again, on the growth and less on the yield. So it's more on the growth of the dividend and the sustainability. That's key.
And based on that, because I'm getting the sense that although our theme for today is a global dividend hunt, we're still very much focused on the US.
Yeah.
And that's because of the regulatory environment. It's more stable.
It's more stable.
I mean, and you're comparing with Europe. And we haven't even talked about emerging markets. Is it more risky?
Yeah. Well, I think Hong Kong is one, we had talked about earlier about bringing up on this episode, and so Hong Kong is something that maybe Singapore investors aren't aware there's zero dividend tax there, right? So if you buy Hong Kong stocks, then you actually don't have to pay a dividend. But if there's an 8-share listing of a Chinese stock, then you have to pay a 10% withholding tax on that, because that's a mainland listed or it's a mainland domicile company, and that withholding tax is 10%. But it's still better than 30%, right?
And that's one of the characteristics.
That's one of the characteristics of the Hong Kong
shares
market. The hate shares, yeah, exactly. And so in Hong Kong, but there are plenty of local stocks that are domiciled in Hong Kong that obviously have zero tax. So there are plenty of companies. I think there are some banks there. If you like banks, that's back in favor. I'm not a huge fan of banks in Hong Kong, just because I think they are probably being disrupted a bit more than maybe the American equivalents. But there are definitely opportunities, I think, in the China space, in financials, either in insurance companies as well. You have some of the solid local power companies in Hong Kong, like CLP, China Light and Power, which pays out a pretty solid dividend. It's not going to light the world on fire. It's a utility, so it yields maybe 4 or 5%, but it's really stable. So those kinds of companies, they obviously you don't have to pay any tax on that. So that's great from a Singapore perspective, I think. Yeah, I think emerging markets generally, it tends to be a bit more of, I guess, an accessibility issue. Can you buy really good shares, and have you got the resources to dive into the companies? And I think that's one of the shortcomings for a lot of EM market, for EMs, is that there's not enough
emerging markets.
There's emerging markets. There's not enough, I guess, content or resources or research out there for you to back it up and be confident putting in, your hard-earned money into a stock there. And in terms of the ETFs, it's less accessible and less liquid if you're going into a local stock market. Whereas Hong Kong is a very liquid stock market, right? So you can definitely easily buy the shares that you want to there.
We have another episode with Tim on the Hong Kong market being the gateway to China.
Yeah.
So more details over there.
Yeah.
But today we'll focus on the dividend play, and we'll talk about some of these Chinese companies.
Right.
Companies in Hong Kong Stock Exchange.
Yeah.
Yeah. And you shared a bit about in terms of dividends,
right,
what should we be looking out for.
Right.
And let's talk a bit about the risks.
Right.
And one of them would be forex risk, because we've gone all over the world, US, Europe, Hong Kong, China.
Yeah.
All right. Forex.
Yeah.
Foreign exchange.
Right. Okay, so forex risk is just, again, that's exactly the same risk you're taking when you buy US stocks or you buy Hong Kong stocks. So in the dividend sense, it doesn't really make much of a difference, I guess you could say. Obviously, you are getting a return in the form of a dividend payout in that local currency, whether it be US dollars or if you're, Great British pounds or Hong Kong dollars or euros. So I think that's just part and parcel of investing internationally. I've always never really been too concerned about FX volatility, because over time it just evens itself out. I mean, you had a period where the US dollar was falling against the Singapore dollar, and now you've got a period where it's strengthening because interest rates are going up. So it all sort of evens itself out. And if you're talking about foreign exchange, unless you're talking about the kinds of movements that you're seeing in crypto markets, where there's up 20, 30, 40%, FX markets.
That's an understatement, by the
way.
Yeah,
probably 80, 90%. Yeah. So I think with FX,
some tech stocks are going at that level recently.
Tech stocks are. But I think from a foreign exchange volatility perspective, that's, I think the FX is probably the least of your worries if you're holding a lot of these growth stocks, right? So, I mean, the US dollar this year has strengthened a decent amount, but then, that could all change dependent on the interest rate outlook from the Fed, if there's a pullback in expectation. So right now, what they're pricing in is 4 or 5 hikes this year, right, for interest rates. I mean, for the Fed funds rate. And if that doesn't materialize, then you could see the dollar, weaken. But if it's faster than that, then the dollar could strengthen. It's stuff that's completely out of our control. So I really don't tend to get too. I try to encourage people not to get too caught up in that, because it's nothing you can really do, and it doesn't affect anything to do with the companies, that their fundamentals or how good their business is. It might impact some short-term earnings, because, if you're a U.S. company that, I guess, derives a lot of your revenue overseas, and you've got a stronger dollar and you repatriate it, then maybe some of those earnings, might be cut, but it might be cut like 1 or 2% or 0.5%. So it's nothing material, I think, is my point. So I think if you're thinking about US dollars, if you're thinking about the British pound, or if you're thinking about euros or Hong Kong dollars, it's all quite similar, one and the same, I'd say. I mean, Hong Kong dollar is pegged to the US dollar. Again, that's another little nugget. I'm not, I'm sure everyone's aware of that, but in case you aren't, like, the Hong Kong dollar is pegged to the US dollar. So that's, I guess, taking out a bit of currency risk for yourself. The risk for yourself, at least in Hong Kong.
Well, because coming from a Singaporean retail investor's perspective, I mean, I invest in Singapore, dividend stocks.
Dividend stocks, right?
It makes sense.
Yeah.
When you venture out, you have to factor in taxes, you have to factor in the forex, and you have to understand each sector as well. And well, if you're doing stock picking, you have to understand the companies they're picking. And well, I can understand some people just put it into a ETF or fund. That makes it easier for a dividend play in that sense. Do you have any advice, on what they should do if they're starting to venture out?
I think it's important to, I think if you're thinking about an ETF, I mean, there are lots of thematic ETFs. Either, there are sector ETFs. So if you like REITs in the US, then you can go for that. But then again, from a tax perspective, that to me, or to anyone, maybe wouldn't be so attractive, maybe because you're focusing on the top level. And so maybe the growth of the dividend is probably going to be pretty vanilla. But if you're looking at venturing out and buying individual stocks, I think starting out with the big, really well-known companies that are just really strong, I think is probably the easiest thing to do before you start diving into it. I mean, in Singapore itself, there are REIT ETFs as well, right? So you could always just go into a REIT ETF in Singapore. That's tax-free. I think ETFs are a great instrument if you want to invest into dividends. And, obviously there are also mutual funds available. But you have to watch for the expense ratios and all that kind of thing and the track record. So I tend to be someone who likes to pick the best dividend plays, I guess, or the best long-term dividend payers. So that's something that I like to focus on. So dividends, I mean, from my own personal thinking is that there's a dividend stock, which is pure yield, right? So something you consider a REIT, which yields 5 or 6%, and it's maybe growing its dividend a little bit, but it's not really got that much growth in there. And maybe you're owning a different asset with REITs, you're owning property. So it's actually not exactly the same asset class as what you would consider a stock. Whereas maybe sort of a Home Depot, which has maybe grown its dividend 20-25% over the past decade, that's a dividend growth stock. So it yields less, as I said, 2% maybe less, but it's growing its dividend really, really fast. So I think it's just adjusting your risk profile. If you want more yield, if that's what you are comfortable with, that's fine. If you want more dividend growth, where you can see that dividend growing quickly over time, then you should have some of that. But I think you should definitely have both of those types of stocks in your portfolio, along with whatever your growth names are that you
because
you
as
would
we're building
have.
our dividend portfolio, well, you want some stability.
You want some stability.
You want some stable source of income.
Exactly.
That's from the dividends.
Yeah, exactly.
You don't want the excitement of the growth stocks, right?
Yeah, exactly. I think, well, I mean, when you're younger, you tend to want to own more growth stocks just because you are able to take more risk. But again, risk is something that's totally personal. So everyone's portfolio will look different based on their own risk profile and what they're comfortable with, holding. Some people are very comfortable with their portfolio going down by 60-70%, and others freak out maybe when it's going down by 20%. So I think it's really dependent on what you're comfortable with, what your risk tolerance is for these types of names. But I think with dividend stocks, as I said, if a company is already paying a dividend, that means it's profitable, tends to be profitable, tends to be generating free cash flow, tends to not be in hyper growth mode. So it's returning cash to shareholders. So you wouldn't see those types of stocks in the SaaS arena, SaaS type arena, except maybe Microsoft, just because it's such a giant and it's worth over $2 trillion and it generates however many billion in free cash flow. So those types of stocks, as I said, won't be losing 20%, 30% of their value overnight. So it's something that, again, provides a bit of an anchor for your portfolio and safety. But it's also a good base to grow out your portfolio for dividends, because I think dividends in Singapore, it's something that you definitely want to take advantage of. And because you're always thinking about dividends providing a stream of income when you retire, or at least if you're younger, you want to retire earlier. My thinking is you won't retire based on investing into DBS, UOB, OCBC, Singtel, all the big REITs here on 5% yields, because you'd have to amass, I don't know, whatever, million, 2 million, or
Your
whatever.
capital needs to be
Your
large
capital
enough.
needs to be large enough to
Yeah.
basically provide that income, right? Whereas if you are starting out with little capital and you're hoping to get to a certain amount of passive income over time, then again, that pays, I think, to think in terms of the growth of that dividend, because even with the 30% tax or whatever, as long as that dividend is growing, compounding strongly over time, that's exciting, because then that initial capital that you put, the return from that is starting to generate compounded returns over time from the dividend. So that to me is maybe more exciting for a younger person who doesn't have as much capital, is that dividends growing really strongly. And then you have other areas where it's more yield focused, but I think it's more about having a mixture of those types of stocks and not just focused on one area.
So when you say dividends growing strongly, I know that's one of the screening factors you look at.
Yeah.
That's looking at historical data. Right?
Yeah.
Of course, you have to understand where the company is at,
Of course,
what
of course.
competitors
Yeah.
are doing.
Yeah.
But how do you forecast for a dividend play?
I think, again, free cash flow, I think I
Okay.
would really emphasize free cash flow, because free cash flow is what determines a company's ability to pay. So I think net income and earnings per share, that can always be fiddled with from an accounting perspective, but free cash flow tends to tell the truth in terms of the business and how it's performing, and actually the cash it's generating right after all the expenses and everything. And so if a company has got rising free cash flow, is generating really strong free cash flow on year after year, and it continues to grow, that's a good sign that the company will continue to pay a dividend or a rising dividend. And so for me, that's I'd say that's the key for an ability for the dividend. Besides, there are lots of other factors that you should obviously consider, but for me, that's the key one.
Thank you for watching this video. If you found it useful, like, share, subscribe, and feel free to leave your comments. You can also join our Telegram group, follow us on social media, and sign up for our weekly newsletter. Everything is in the description. For more content, check out thefinancialcoconut.com. What's your biggest failure? And what did you learn from it? It need not be financial.
Okay, I'll probably take financial, just because it's probably the easiest that comes to mind. For me, I have a story of a company I invested in probably in about 2015 probably 2012 to 2014. So it was a little company. It was not little anymore. It's still pretty big, called Lenovo, which just got added to the Hang Seng Index, or got re-added to the Hang Seng Index after it dropped out. So back in 2011-12 period, I think it was doing really well in terms of smartphones. It was doing really well with the PC market share that it had. They obviously performed very strongly in terms of the share price as well. And so that was something that I was really interested in, I guess, from a Hong Kong investor perspective, because I was living in Hong Kong, working in Hong Kong. I followed Asian equities in my previous role, so that's something I've always been focused on. And so Lenovo was a company that I started to invest in on a monthly basis from a DCA perspective. I was really quite keen on it.
Dollar cost averaging.
Dollar cost averaging. Yeah. And so, I think it performed pretty well for about 6 months a year. But then it obviously started to peak around maybe 2013 or end of 2013. And I think one of the mistakes from my end is that I just didn't really do enough due diligence on the business and the competitive landscape. And so if you think about it in hindsight, you always think, oh, I should have known that. But maybe knowing what I know now, or reading up and just being a bit more maybe informed about everything, I think I should have known better about the competitive landscape to the business in Lenovo's business. The hardware business, so to speak, it's so competitive in the electronic space. And so they did really, really great with their handsets for maybe a year or 2 years in China, and then they started to fall out because, as you know, you had Huawei and Oppo and Xiaomi come to the fore, and then Samsung, and so it kind of became a second-tier company in that respect. And they were at that time entering into data centers and enterprise data centers, and that wasn't really taking off strongly. And it taught me it was a good lesson, I think, for investors, because everyone makes mistakes and everyone should learn from them. Just for me, maybe it taught me that I didn't really want to be involved too much in electronics hardware. And since then, I've not really been that keen on that space unless they're a market leader. I mean, you see in Samsung and Apple, they're just so big and so huge that they have that influence over the market and the pricing power. And Apple, for one reason I don't hold Apple SG is because of the physical production of phones, and there were so many risks with supply chains and all that. So I think for me, that was one reason I've never been a huge fan of it. But obviously, the share price returns tell a different story, and they've been amazing. But I think for me, Lenovo was a lesson just to think about due diligence, thinking about the competitive landscape, understanding what types of companies you want to be invested in, because some people really like to invest in electronics companies, electronics hardware companies. But even today, the types of companies that you see like Xiaomi and even Lenovo now, they still really don't appeal to me, and I've got no interest. And I think that was probably something I learned from that whole ordeal. And I cut the investment at a loss, but that's, you have to deal with that. I think it was like 40% loss. But good lesson. Not too expensive, thankfully.
What's the biggest challenge in your life right now, and how are you tackling it?
Okay, biggest challenge for me is trying to find enough time to do exercise, because I think this is something I had mentioned before, that I trying to exercise more, and I think it's something that I've neglected for the past couple of years with young kids, and it's something that I want to focus more time on. I used to play a lot of football. I used to do yoga. I've had a bit of a wrist injury recently from doing yoga, actually, ironically, but I think I pushed myself. So I think it's trying to find the time to really focus on your well-being, which I think has been neglected but now football's back. It's thankfully, with social distancing measures being eased, I can hopefully maybe get a game of five-a-side in at some point. And as a father of two, it's important to be active and just take care of yourself, eat well, but also exercise, which is something I'm finding very difficult to do right now.
If you could be remembered for one thing, what would it be?
I think just providing advice or good lessons for investors. I just want to try and help investors invest more intelligently and try and think about long-term investing as a great way to generate long-term wealth and to be patient. So I think for me, it's more about reaching out to people, and hopefully they remember what I've written or what I've appeared on and what I've said about specific topics, because I always find the world of investing really interesting, really ever-changing, right? There's always something going on, a different dynamic. Like now you have the Ukraine-Russia tensions, and that's freaking everyone out. But that will probably pass, and then the market will figure out a way to hopefully over time go up. So I think it's more about wanting to reach a bigger audience and hopefully educate them on the benefits of long-term investing and staying patient and thinking beyond just the next 3 or 6 months or 12 months.
Right. I mean, this is our second conversation. You talk about patience a lot, long-term investing,
right,
and don't find certain types of investing style boring. Like, that's really important for you.
Right.
Where did that come from?
I think it was. I think a lot of it was shaped by obviously my time at. I worked at Schroders, which is a big fund manager. They're really focused on long-term investing in the Asian equities team. And then I worked at the Motley Fool, which is a massive proponent of that long-term mindset. And that's where I really, I think, took a lot of things to heart, understood a lot of the dynamics of the market psychology, understanding that you can't freak out every time the market falls, 1-2% or even 5-10%. And eventually, if you look at market history, if you look at market data, it will always recover. It's just more about being patient and keeping your emotions in check, which I think is really difficult for everybody, because there are those base emotions. Everyone feels it. I feel it. You feel it. Everyone does. It's more about just trying to take a deep breath, focus on the long term, focus on where your portfolio, how it might look, in 5 years, 10 years, and measure yourself on those time frames rather than over 6 months, 12 months, because in that time frame, it's not enough to tell whether a company is doing well or whether the market's going to make you money over long term as well.
Okay. All right then.
Yeah.
Thank you, Tim.
Yeah, no worries. Thanks for having me, Andrew. It's been a good chat.
Here's a word from our sponsor. This podcast does not constitute an offer or solicitation to buy or sell any security or instruments, or an invitation or recommendation to enter into any transaction. All capital market products contain risks and may not be suitable for everyone. Please refer to the risk disclosure statement in the general terms and conditions of CGS-CIMB Securities Singapore Private Limited. Company registered number 198701621D for more details.